What is going on YouTube? So welcome back to another video. In today's video, I'm going to be taking you through how you can risk only 1% of your account balance per trade that you take, and also how this can help you to reach profitability. If you are already a profitable trader, this video is still for you, as it can show you how to increase your profits and overall become a better, more holistic trader. So if any of that sounds interesting to you, make sure to stick around until the end of this video, and I would also appreciate it if you could hit the like and subscribe button as well. But without further ado, let's get straight into the video. Alright everybody, so before I get into actually how you can risk 1% of your account balance per forex trade and how we go about calculating the correct lot size, I just wanted to explain to you why risking 1% and risk management in general is essential to profitability and is one of the key components of being a profitable trader. So I've listed 4 bullet points which basically summarize the importance of risk management. So the first point I wanted to make was that risk management and keeping your risk parameter constant can give you a statistical edge in the market, because if you have a consistent risk percentage per trade, you allow the probabilities to play out in your favor. For example, if we have, say, a 1-to-3 risk to reward ratio per trade that we take, that means that if we are risking 1%, the maximum amount we can lose on that trade is 1% of our account, but the potential reward or the potential gain per trade that we take is 3%. This means that we only have to have a 30% win rate in order to become profitable. So if we just take an example, let's say we take 100 trades over the course of let's say a year. If we win 30 of those trades, so 30% win rate, and with a 1-to-3 risk to reward ratio, risking 1% per trade, that means our gain is 90% of the account. And we then also lose 70 out of those 100 trades. So the total gain would be 90 take away 70, so 20% gain in that year, even though we lost 2/3 of those trades, or 70%, sorry, of those trades were losers. We still ended up with a nice profit to end the year simply by employing risk management to our advantage. It also, we all know that psychology and emotions play a huge part in your trading, because most people have a predisposition to emotional attachment to money. Obviously, because it's such a big part of everybody's lives, we have been conditioned to have this sort of emotional attachment to money. So logically, if we're only risking a 1% of our account balance, then this is going to clearly reduce any emotions in our trading, because the amount is relatively small compared to our account balance. And we also know psychologically as well in the back of our heads that in order for us to blow the account, we would have to lose 100 consecutive trades without any winners. So taking that into consideration, it's nearly impossible to blow your account unless you're taking, like hundreds of trades per day, and then all of them are losers. Final point as well is that we want our trading to be almost as mechanical as possible. So risk management eliminates any subjectivity, because going into any individual trade, we know how much we're gonna risk, how much is our potential loss, or how much does it cost to enter that trade is another way of thinking about it. We know how much our potential gain is. So using this example, a 1-to-3, our potential gain is 3%. So we're keeping the risk constant no matter how we feel about the trade. So another mistake that I see a lot of people make is that, let's say they feel confident about a particular or individual trade, then they will risk twice as much on that trade. Whereas say they're less confident about a trade, then they'll risk half of what they usually would. But the reason this is a bad thing to do is that it introduces this element of subjectivity in your trading, which means that let's say you're looking through your data, you do not know for example, the data will be skewed because on some positions you've risked 0.5%, some trades you've risked 1%, and some trades you've risked 2%, simply because of how you felt at the time. Also add into that, let's say you are confident about a trade, that trade can still lose, whereas the one you were less confident about, it could be the winner. So why would you change the risk depending on how you feel about any individual trade? It literally makes no sense. So risking 1% per any position, no matter how we feel, reduces this element of subjectivity and therefore increases the chance that we are profitable in the long run. So now that we've got the importance of risk management out of the way, we can go over to the charts, and I'm going to show you exactly how you can go about calculating the correct lot size in order to only risk 1% of your account balance per trade. So first of all, we obviously start with actually finding a valid trade to take. So let's say we go back to here. This was the trade I was looking at this week. So if we go over to the 4 hour. So if you haven't watched any of my previous videos and are unfamiliar with this strategy that I'm about to go through, I would recommend watching those first. But the point of this video isn't to teach a particular strategy. So if you want that, you can completely ignore the strategy if you have your own strategies that you use. The strategy in this video is completely irrelevant. It's just to demonstrate an example of how we would do this and how you can replicate this for any trades that you decide to take. So at this point in time, euro pound was consolidating, as we can see, and price had swept this previous weekly low, like that. And then I went down to the lower time frames and simply observed that price had swept this low. This was the lower high, this was the lower low. Price then closed above the lower high, so that was the change of character. And also crucially, if you trade this type of strategy, we also had a sweep of a major low to the left, which is why this change of character was valid. We also had a clear sweep of this low. So a lot of people would have been seeing this as a breaker structure to consider to continue to the downside. But since we had a sweep of the low, followed by this impulsive move up, taking out this most recent structure, we know that price is likely going to continue up instead. So this was the area of demand on the 30-minute, which caused that structure to break to the left and also took over supply. In addition to that, we had 3 equal highs up here, which I was looking for price to target. In my opinion, there was a low probability that price continues to the downside and reacts from this area because of all this liquidity above. I believed that price needed to come a little bit higher before we were going to continue to the downside. So at this point, we simply set a limit on this area, stops just below the demand and targeting the liquidity above. So at this point, this would be when we would go over to MetaTrader 4 and place our pending or limit order. And this is the key element of this video, how do we go about calculating the correct lot size on this trade in order to make sure if this trade hits stop loss and goes against us, that we only lose a maximum amount of 1% of our account balance? So what we do is we go over to, we just pull up this, we type in MyFXbook position size calculator. This is completely free as well. Go to the MyFXbook website and we see that this software comes up. So what we want to do is simply follow the instructions and input the correct values. So obviously for currency pair, in this case is euro pound, simply just change that depending on what pair you're trading. Account currency, whatever your account currency is. Account size, let's use the example of a 100k funded account or live account. Risk ratio, this is where we want to input the number 1 so that we're only risking 1% of our account. Stop loss for this trade was or 9.3 if we want to be a little bit more precise. So we just put 9.3 into there. This one trade size in lots, just keep it as 1, don't change that. And here are the results. So it's basically telling us that we are risking $1,000 on this trade, which is obviously 1% of our account, which is $100,000. This bit here doesn't matter. What matters is this bit here, which says size in 8.57 lots. So if we want to risk 1% of the account, so risk $1,000, this is the lot size that we're going to input into MetaTrader 4. And what this basically means is that if price comes and takes our stop loss at 9 pips, then we're just going to lose 1% of our account and we're out of the trade. Also, before we continue and see how this trade played out, I wanted to add on as well that obviously this isn't going to work if you get emotional and hold the trade past the stop loss. The stop loss is there for a reason. There is literally zero logical reasoning behind holding the trade past the stop loss. Obviously, if you have a well back-tested strategy and you have clear defined rules, the stop loss is there for a specific reason. So why would you hold it past that point? So this means that if we hit the stop loss, it's fine. We just lose 1% of our account, nothing too major. And if price hits our take profit up here, then you can see here risk reward 3.14, which means that we are going to gain $3,000. So if you think about that over the long run, if we have a 30% win rate, 1 to 3 risk to reward, we are going to end up with 20% gain over 100 trades. So yeah, that is simply how you can risk 1% of your account balance per trade. If we just see how this trade plays out now. There we go, price tags into demand, then comes up and targets those 3 equal highs as liquidity just above. So we would have gained $3,000 on this trade, or 3% of our account balance. And obviously if this had gone against us, we would have lost 1%. So that's all I wanted to mention in this video. Risk management is one of the most simplest aspects of trading because it's literally just rinse and repeat. You input all of the parameters into the MyFXBook calculator. You then put the correct lot size in, and then at most you lose 1% of your account balance. There's literally zero more to it. And this could be the difference between profitability and unprofitability. I've seen it so many times. There literally is zero reason why you guys cannot incorporate this into your trading and hence become profitable. Obviously, if you have a winning edge in addition to that, risk management is only one facet of a multifaceted trading plan. However, I hope you guys enjoyed this video if you did manage to make it this far, and I hope this has positively impacted your trading in some way or another, and you can now implement this into your trading strategy if you don't already. So thank you guys for watching this video. I hope you enjoyed. Make sure to like and subscribe, and I will see you in the next one.